Hi everyone, I welcome you all on my YouTube channel, and today's topic is going to be about mastering balance sheet insights, and this is a question and answer session for balance sheet, and all the possible questions which can be asked related to balance sheet will be covered in this video. And if you have any topic you want me to cover, please write to me in my comment box so I can make video on that. So before any further ado, we will get into the video. First question is, what is balance sheet? So before going another question, it is very important to know that what is balance sheet. An interviewer often ask the candidate what is balance sheet, and at that point of time you should have the answer ready. So a balance sheet is a financial statement. As we all are aware of that, there are three major financial statements, that is a profit and loss and cash flow, and then balance sheet. These are very important. So balance sheet is also one of the major part that presents a company financial position at a specific point in time. It consists of three main components. Assets. So asset is basically what a company owes, owns, that is the asset. So whatever the company has which is not a liability, which they own, that is going to be the asset. And majorly it covers cash, inventory, property, plant and machinery, furniture and fixtures, debtor. So these are all the part of assets. Now we have liability, what the company owns. For example, any loan, accounts payable, vendor which are yet to be paid, that is our liability which a company owes. So that is going to be our liability. And then we have equity, the owner's stake in the company. Example, retained earning and share capital. So equity majorly consists of these two. The first is retained earning and then share capital. It follows the equation. In accounting, always the equation is that asset should be equal to liability plus shareholder equity. That is the rule. And if there is any discrepancy in both the equation, then you must have done something wrong. So it is always to verify, and assets should always be equal to liability plus shareholder equity. If you have seen the balance sheet, the first we have first the shareholder equity, then we have the liabilities, and then in the below we have assets. So this is how the balance sheet is made. Now we have second question, what are the main component of a balance sheet? So majorly the main components is the same which we discussed in the first question. First is assets. Assets include both current and non-current assets. And in current asset there are fixed assets and then current assets. And in liability is also a major part of major component of balance sheet. And liability is also two types, that is current and non-current. Then we have equity, which includes share capital, retained earning and reserves. Now we have third question. Why is balance sheet important? The balance sheet provides insight in a company financial health, solvency, liquidity, and ability to meet organization obligation. It helps investor and stakeholder analyze the financial strength and operational efficiency of a business. So whenever there is a stakeholder who wants to invest in your business, he will always check these ratios, solvency, liquidity, to check the financial health of the company, and these ratios is only can be created with the help of balance sheet. So it's balance sheet is very important to know to do the financial analysis, and financial analysis part cannot be completed without creating the balance sheet. And after the creating balance sheet, these ratios, solvency, liquidity, and there are other ratios as well which are find out, and then we check the financial health of the company. Then as per the data, we try to improve our company's liquidity and solvency. And also the investors also check these information before putting their money into the business. So balance sheet is very important and it plays a crucial role. Now we have fourth question. What is working capital and how is it calculated? So working capital is much needed to get the operations going of the business. Without working capital, we cannot operate the day-to-day activity of the business, and this is very crucial part of the organization. Now we will check what does working capital is. Working capital equal current assets minus current liability. So after deducting current liability from the current assets, we get the working capital, and it represents the short-term liquidity of a business, showing its ability to cover short-term obligations. And we always want our working capital to be high so we can meet more obligation, as much obligation as we can. So it is very important to have the current assets on a higher side to get the working capital higher. Now we have fifth question. What is the difference between current and non-current assets? So basically, current assets is a short-term asset which is convertible within the 12 months, within a year, and it often includes cash, inventory, account receivable, that is our debtors. Now we have non-current assets. Non-current assets is basically fixed asset, and these are long-term assets, and their life is more than 12 months, and also it converts it has more than a year, like land and building, furniture and fixtures, equipment and goodwill, patent, copyright. These all are the non-current assets. Now we have sixth question. What is the difference between current and non-current liability? Same goes for the current and non-current liability in terms of the time duration. Current liability is short-term obligation due within a year, that is our accounts payable, short-term loans. Now we have non-current liability, that is a long-term obligation payable after a year, that will be our long-term loans, bonds payable. And often we see that if there is a loan, that is going to be non-current liability. but we do have short-term loans as well, so that will be classified as current liabilities. Now we have seventh question. How do you analyze a balance sheet? And this we have discussed in the above question as well, what we analyze and how it is important to analyze these. So key method of analysis includes, first is liquidity ratio, and liquidity ratio includes current ratio also and quick ratio also. And this is very important if you are going for financial analysis interview or investment banking even. Then this question is asked, the ratio is asked to you. And then we have solvency ratio. In solvency ratio we have two ratios, debt to equity and debt to assets. Then we have profitability matrix, that includes return on equity and return on assets. Now we have trend analysis, comparing your changes in assets, liability and equity. Now we have eighth question, what is goodwill and how it is recorded in the balance sheet. So basically goodwill is our intangible assets, and there are many intangible assets like patent, copyright, trademark, and goodwill is one of the intangible assets that arise when a company acquires another company for more than its net asset value. It is recorded as non-current asset and is subject to impairment testing. So basically whatever the extra amount you pay to a company to purchase their company after the valuation, that is goodwill. Why you have paid the extra amount? You have paid the net assets value of the company, and if there is any difference, that is calculated as goodwill. Because of the goodwill you have paid the extra amount to the company. So that is our goodwill. Now we have ninth question, what is deferred revenue and where it is recorded on balance sheet. So deferred revenue or unearned revenue represents advance payment received for goods, services yet to be delivered. It is recorded as current liability until revenue is earned. So we have not delivered the goods and services, but we have received the payment of that. So we will record it as our liability because the services and goods are yet to be delivered, but we have received the amount. So that is our deferred revenue, and it will be recorded as current liability until we have earned it. And I have made a separate video related to journal entry, and also I have explained in one video the accrual concept. If you wanted to check in detail, you can check both of the video and get a good understanding over these terms. Now we have 10th question. How does depreciation impact the balance sheet? So depreciation is basically when there is a reduction in your fixed assets due to their life and due to the wear and tear. So that is our depreciation. And depreciation reduces the book value of fixed assets over time. It is recorded as an expense in the income statement and accumulated in the balance sheet under accumulated depreciation, and it is in a contra entry. So I hope you find this video helpful, and if you want me to cover any specific topic, I would love to do that. So thank you.